Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. 2022 has not been a good year for property, with rising rates hitting house prices hard. Of course, it's a very cyclical industry. 2021, for example, was a boom year. 2022 was pretty much the opposite. One of the companies seeing that firsthand is Domain, which this week lowered its earnings guidance following a decline in listings. Jason Pellegrino is the Chief Executive Officer of Domain. Jason, welcome back to Fear and Greed.
Thanks for having me.
So, just how tough has this year been? I know you came out downgrading earnings guidance a couple of days ago, but tell us about the full year.
Yeah, really, it was a year of two halves. The first half probably had the strongest listing environment that we've seen in living memory as a digital business, at least. It's very strong listing volumes. Property prices peaked in the first half of this year. And at that peak, we'd seen a 33% increase in the average price across the major capital cities since the prior trough. And that's an extraordinary rise through that COVID period that no one really expected. If we come into the second half of the year, we saw a distinct change in September and really a change in sentiment on the listing side where people were taking their time to reset expectations around prices. Prices started to decline. By the end of the year, we've seen a 4.5% to 5% decline in prices across those major capital cities, with Sydney and Melbourne leading that. Sydney is close to 10% decline. And, vendors taking their time to sort of reset expectations, and in that had sort of started to really slow down in stepping through the various thresholds that they need to step through to actually list their property. And we've seen a very tight listings environment. So we went from record listings in the first half of the year to, being down 20, 30%, even 50% year on year in December towards the back end of the year. So really, it's a tale of two halves.
And for Domain and organisations like Domain, is it about listings rather than prices?
Yeah, absolutely. Our business model is very much on helping vendors find the right buyers for their properties. And so our business is fundamentally driven by listing numbers. And when they fluctuate, as they do, it's a cyclical property market, it has an impact on our business. Now, the one thing we know well, and we've learnt, incredibly well over the last several years, in a few years of extraordinary volatility, not just with COVID, but before that we had 18 months of impact of the Royal Commission and the impact on the property price and the property listings volume market that happened around that time. Is listings don't disappear or appear. It's really around timing and sentiment. I sort of mentioned that in order to sell a property or buy a property, there are certain gates that everyone has to walk through. And in periods that we saw, say, at the beginning of this financial year, people were running through those gates really quickly with confidence. And so listings were coming to market really quickly and transactions were happening quickly. Time on market was really low. In fact, in some suburbs, we had average days on market for houses of, sub 10 days.
Wow.
And there was such. What we have now is people are sort of stopping or slowing down at every one of those decision gates. And what it does, it slows listings. But we know that over 80% of listings happen because of demographics. It's births, deaths, marriages, divorces, new jobs. And so it's not that someone now who's not deciding to list their property has a choice not to list it. It's just that they're choosing not to do it now before Christmas, and we'll re-look at things in the first half of next financial year. So any listings that we're sort of down at the moment, I can't tell you whether they will come back in February of next year or June of next year or October. But I do know that they do come back. And that's the pattern that we've seen over the last several years and we're confident about.
Okay. How important in this whole process then are interest rates? And is that the fundamental reason why people aren't running through the gates anymore?
I think it's been the single biggest driver of creating doubt and, definitely slowing people up at one of those points. So, interest rate rises have absolutely had a direct impact on people's affordability. We've seen people reduce their budgets by 10 to 20% because of what's happening. And this is where interest rates have been reset from even 12 months ago, looking, your ability to find a loan starting with a 3 has now been sort of replaced by struggling to find a loan that starts with a 4 and you're probably into the 5s in terms of where you can get to. And that changes people's budgets, and that does go through. On the vendor side, the uncertainty of how quickly that's going to happen causes a problem. And so I think that the interest rate rises themselves are an issue. I think the amplifying issue has been the rate of interest rate increases and the fundamental U-turn on the narrative by governments and the RBA on how aggressively those rates will increase, which has just, turned a complete corner from 12 to 18 months ago.
Who do you blame? Is that a thing that the Reserve Bank should put their hand up for?
It's hard to blame anyone in specific because no one's got a crystal ball to say exactly what's going on. But, I would point to probably two aspects. Firstly, the power of these interest rate increases to not just have an impact on the property market, but the spillover of people's confidence in the Australian property market because of the importance of residential property as a proportion of total wealth across the country. It's close to $10 trillion of the $16 trillion household wealth in Australia. It's enormous. It has flow-on effects across the economy. And that's fine. People are known, but we have this sort of history of, after the fact, some of our institutions coming out and sort of talking through of underestimating, for example, the impact that they'd have on the broader economy through actions that were raised. We saw this through the Royal Commission and the sort of constraint of credit that happened a few years ago. I think there's a secondary issue, though. One is that we have a complex set of circumstances that are impacting global economy, not just Australia, that are impacting things like inflation. And we're stuck globally, I think, trying to solve complex problems with simple tools. And the first thing that I'd sort of point to is I'm not convinced that raising interest rates is going to impact on inflation in the same way that it may have, several decades ago, because it was a lot simpler problem. And I point to the reverse situation that Japan has had over the last, decade or two, where monetary policy really just hasn't had the impact on economic activity that the sort of the banks over there or the government over there wanted it to have. I think it's a similar situation in Australia. I'm not sure that the pain of these interest rate increases is going to have the impact on inflation that probably would otherwise have had in previous years.
Stay with me, Jason. We'll be back in a minute. My guest this morning is Domain CEO Jason Pellegrino. Jason Pellegrino, how do you run a business then in these circumstances? How do you run a cyclical business like Domain when so much of this is going on? I know a couple of days ago you said that you were cutting costs and you've been able to get costs out of the business, but you must have to start thinking fairly laterally to get the top line growing as well.
Yeah, there's a few things that we do. Overall, I think we need to run within a margin of safety and recognise that this is a cyclical business that will have ups and downs. In times of plenty, when the grass is green, you need to be careful that we don't get ahead of ourselves and overinvest because, the times will change and the cyclical market will turn down. And I think that's one thing that a lot of technology businesses are learning at the moment, and it's a pretty global trend around the pace of investment relative to the ambition that's out there. I think that we are setting ourselves out to build a business that looks through cycles, not tailoring ourselves to individual cycles. So over the course of 3 to 5 years or 10 years or a generation, we believe, or I fundamentally believe, that Domain has an extraordinary opportunity to have a much larger impact on the property ecosystem across Australia. And we need to prioritise our investments to deliver that multi-year journey, that multi-year strategy, rather than trying to actually run a business month to month or year to year. Now, that doesn't excuse us from not understanding the market circumstances around us. And so some of those cost cuts that we announced, a few weeks ago were really about sort of tailoring our investment, the pace of our investment, to a fundamental change in the market conditions versus when those budgets were put in place, for example, to start with. So it's really a balance of keeping your eye on the long game and investing and prioritising through that, but also not being blind to the current market situation that you're actually in. It really becomes a balance.
Okay, just quickly, when you're talking about what you're investing in, what are you talking about? What sorts of things can we see Domain investing in the next 2, 3, 4 decade, really?
Yeah, so really simply, we're building a broad-based property marketplace that will have a large impact across the property ecosystem in an asset class that is easily the most important in Australia for households, for wealth, for even social elements, things like affordability, housing and a whole range of different things across that area, Domain can have a much bigger impact. So that doesn't mean that listings and marketing support's not going to continue to be a core part of our business, and we will continue to grow and innovate in those areas, help agents and vendors find the right buyer, help buyers find the right property. But we can play a much broader role. We can help Australians reimagine their place on the property market and ecosystem. We can help them not only sort of buy and sell property, but potentially increase the value of that property, understand what they could do to increase and have better outcomes in their ownership of that property over time. I point to things like helping Australians really understand their carbon footprint through home ownership, for example, and what they can do to not only reduce the cost of operating a home or owning a home, not only reduce the carbon footprint that they're consuming through the ownership and operation of that home, but also increase the value of that property. Research that we've shown is that properties that have sustainability features, for example, sell for about $125,000 more on average than properties that are lacking those sustainability features. So often when you're looking at installing solar or insulation, you're looking at that on a cost return. It's going to cost me X, and this is the number of years of benefit that I'll need to actually sort of pay off that. But people are not considering the capital uplift in the property that actually happens. And we can bring that to bear and help people understand what's the right investment to make to not only increase their wealth and the value of their investment, but also meet their own increasingly society's sort of objectives around reducing carbon footprint.
Are you looking forward to 2023, Jason?
I am looking forward to 2023. Before that, I'm actually looking forward probably slightly more. And so let's do a little bit of a break over Christmas.
Good.
And, our team is definitely, it's been an extraordinary year. And the team at Domain has been extraordinarily resilient and innovative. We have continued to sort of focus on bringing new products to market, on sort of building our reach to a broader customer base, whether that's consumers, whether that's agents or corporates and government, and has sort of weathered the storm through an extraordinary inversion from a first half that was as strong as we've ever seen in the property market to almost overnight, some of the toughest conditions we've actually seen. And a team that's actually sort of worked diligently throughout to bring a lot of our products and capabilities to market.
Fantastic. Jason, thank you for talking to Fear and Greed.
Thank you.
That was Domain Chief Executive Jason Pellegrino. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.